On Business Incorporated today. Global sugar prices up more than 8% as sugarcane demand for ethanol demand increases. Ghana restricts export of maize and soybeans. The United Kingdom partners Nigeria on strategies to achieve sustainable development goals. Hello and welcome to the program. I'm Ini John Mekwa. Well, let's start as usual with market numbers we track here in Africa, which were fairly positive at intraday. Nigeria's main index, well, sustained yesterday's positive sentiment. It was up 0.36%. That continues yesterday's bullish move, while South Africa's JSE fell by more than 0.5%. In Egypt, the EGX30 was looking quite strong by almost 2% gain. Meanwhile, Kenya closed negative yesterday. Over to the Middle East now, where most of the markets we track were in the red zone at intraday. In the United Arab Emirates, Abu Dhabi index posted a 0.63% loss, while the Dubai main index was also down. It's retracted by over 0.5%. Elsewhere in the region, the Qatari index was down almost 3%, while Saudi Arabia's market was the lone gainer. It was up 0.77%. We move to Europe now, where German government says it will not pursue fracking in its desperate bid to find gas as a replacement for Russian imports. The country's economy minister rebuffed an opposition call to explore domestic drilling and extend the timeline of nuclear power plants. He said that the government's focus remain on a faster build-out of renewables. Well, we have Stephen Beardsley now joining us from Berlin to give us details of that. Hello, Stephen. So is this fracking even a realistic option for the German government?
Well, to this point, it has not really been a realistic option. Now, there is small-scale gas production across Germany that's still going on, especially if you look at the northwest of the country, but it's not a wide-scale production. And over the years, it has only gone down as Germany has connected to outside sources. We're thinking especially of Russian gas, which is what we're talking about so much these days. The most recent studies have shown that shale gas reserves in Germany are actually quite considerable. There is a question, however, of how accessible they would be. The bigger problem here is that politically, fracking is not an option. There is a strong public opinion against it. There has been for years, and there is a law that's been on the books for several years now that prohibits fracking for anything but testing. That means commercial production of gas from fracking is not even a possibility. So this conversation really demonstrates part of the absurdity of the energy politics here in Germany. This is a highly industrialized nation that needs a lot of energy. And yet at the same time, it has tethered itself to a country that's very unpredictable and that has proven to be a mistake to have a connection to them, that is Russia. And then it has ruled out a lot of other possibilities that would serve as alternatives. We're thinking of nuclear, of coal, and of course, of domestic gas.
And talking about alternatives, do we see renewables as an alternative to gas?
In the short term, the answer is absolutely not. Gas imports here in Germany are considerable, and they are responsible not just for heating across Germany, but also for electricity production. And there are certain industries, one often talks of the chemical industry, which then serves other industries across Germany that are heavily reliant on gas for production methods. Now, renewables are pretty well built out across Germany. That has grown in recent decades. And relative to Europe, it is a very high build out of renewables. At the same time, it is a very slow process, and it has slowed down in recent years. So that's not something that's going to take place in the short term. In the middle and long term, the discussion of renewables really comes on. So there's the question of what to do about this gap in gas. If Germany is to quit Russian gas, it's going to have to find it through LNG, liquefied natural gas. But that's also in short supply these days. And then other providers such as Norway, such as the Netherlands, they are also really at the maximum exports that they have right now. So finding that replacement is really going to be the question right now.
And how is the market reacting to all of this?
What we've seen so far is that European markets have taken a dip that was expected. In particular, in London, we've seen the FTSE 100 has been affected by new jobless data there, showing that joblessness has gone down again, and that makes inflation even more feelable there, you could say. But then really everyone here is looking at the U.S. to see what new inflation numbers there show. If inflation proves to once again be at very high levels, and that increases the odds that the Federal Reserve will move faster with with interest rate hikes, and that of course would have an effect on the U.S. markets, which then ripples across the world. So that's why we've seen markets in Paris and in Frankfurt so far down this morning.
All right, Stephen, thank you so much for that update. We'll do it again tomorrow. Let's move on now to the UK. Well, 2022 has been described as a year of the squeeze, not just in the United Kingdom, even here in Nigeria. The World Bank released that report yesterday. But let's focus on the UK now and the conversation. We have Juliana joining us now. Hello, Juliana. Good afternoon.
Good afternoon, Ine.
So I know in the morning you spoke with Ladi about the jobless market, and you did indicate that it's both good and bad news. And then we're looking at the gap between public and private sector pay that could make it difficult to recruit staff for public services.
Well, that's right. The way the British would describe the data released by the Office for National Statistics this morning is a mixed bag. So some good, some bad. If we deal with the good news, it's that 35,000 people joined the labour force last month, which means that unemployment has been pushed down yet again to about 3.8%. And that's the lowest unemployment has been in this country since the last quarter of 2019. So that's good. Unemployment being down in an economy is always a good thing. The problem is people that are in work are not seeing their pay stretch as far as they would, and that's because of the cost of living. The cost of living in this country is currently 6.2%. We are getting inflation data tomorrow, and there are some suggestions it could be anywhere between 7 and 11%. And that is a lot, especially if you consider that the benchmark from the Bank of England is supposed to be 2%. So we are experiencing high levels of cost in the UK, not only at the petrol pumps, not only at the checkout, but also as well when we're heating our homes or cooking our food because of the increase of more than 50% in energy bills. And that's a huge issue, and that's one of the reasons why we didn't really see any investor reacts that was positive following the release of this labour market data, because people are still struggling. You mentioned the difference between public and private sector pay. We know that if you work in the public sector, then these are the type of people who are teachers, NHS, those sort of staff, police officers. They have really struggled to get an increase in their pay. I believe they got about a 3% increase last year. If you see that the cost of living is up 6.2%, that actually means a real fall in wages. And this is really affecting individuals. And now employers have a choice. Do they start lifting the wages of their staff? If they do that, they keep them happy. But then, of course, some prices have to rise elsewhere. It's a really tricky situation that the UK, not just the UK, as you mentioned, Nigeria too, the world economy is facing at the moment.
That's right, Juliana, because talking about inflation, we're expecting us on Thursday, and it's not 11, it's heading to 16, so it's everywhere at this time. But British Retail Consortium has released figures that capture sales growth for the month of March. What are some of the findings from the figures?
Yeah, not great, but there's still some growth. British Retail Consortium revealed that retail sales last month up 3.1%. Growth is something, but then if you compare it to the quarterly average of about 6.8%, it is coming down. And again, it just really doubles down on what we were just talking about with the cost of living. You cannot go anywhere in the UK without hearing it. It's screaming at you from the tabloids, from the media, on the radio, squeeze, 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 tight, tight, tight. And if you're hearing that, of course, you're not going to be spending. You are going to be second guessing that extra spend, which is not what the Treasury need at the moment. But clearly that is reflected in this data. And we're actually looking at in the rearview mirror. We're not looking at what's happening now. We know that things are getting worse because it was only a couple of weeks ago when the national insurance tax increased. And then, of course, we had the Ofgem energy regulator lifting that price cap. So things are not looking good. And, of course, we got that GDP data didn't we, yesterday, showing that GDP only rose 0.1%. So it does appear as if it is going to be a very tough couple of months ahead for the UK.
Yeah, and how are the markets reacting to all of this?
Not great. Just as you were talking to our colleague in Berlin, I did have a look on my phone. We actually did just get the inflation data from the labour market statistics in the US, showing that inflation, again, 4-year decade, 8.5%, really, really high. We're expecting to get something similar in the UK tomorrow. Now, investors were watching and waiting, anticipating that data is coming much higher than economists had expected. So the data I'm giving you now for the markets is probably a lot worse at intraday, but the FTSE All Share is down 0.49%, the FTSE 100 is down by 0.45%, and the FTSE 250, the domestic market, that's down by 0.72%. In the currencies market, the British pound is down on the US dollar by 0.04%, though up on the euro by 0.09%, and up on the Japanese yen too by 0.02% in E.
All right, I'm sure we'll get a feel of reactions to that U.S. inflation data by tomorrow. Thank you so much, Juliana. Enjoy the rest of the day.
Thank you.
Let's move to Asia now. Shares in Asia-Pacific were mixed as investors continue to monitor developments surrounding the COVID situation in mainland China, as well as movements in Japanese yen. Chinese markets recovered partially from yesterday's heavy losses, swinging between positive and negative territory in choppy trading before closing higher on Tuesday. The Shanghai Composite closed 1.46% higher at 3,213.33, while the Shenzhen Component jumped more than 2% to 11,756.38. Over in Hong Kong, the Hang Seng Index is hedged higher at 0.52%, finishing the trading day at 21,319.13. Shares of Tencent and NetEase rose 3.62% and 4.21% respectively after Chinese regulators approved new games for monetization following a months-long freeze. Elsewhere, the Nikkei 225 in Japan led losses among the region's major market as it fell almost 2% on the day to 26,334.98, with shares of robot maker Fanuc dropping 5.47%. The topics index dipped 1.38%. Australia's stocks also declined, with S&P AX 200 closing 0.42% lower. Moving to the United States now, U.S. stock features were little change as investors braced for a key inflation report. Features on the Dow Jones Industrial Average gained 20 points, while S&P 500 features ticked up 0.1%. Nasdaq 100 features also climbed 0.1%. The moves come as investors await the release of anticipated inflation, which Juliana just told us now came out higher than expected. And let's see what's going on in the global oil space now. We see that oil prices climbed today as fears of demand downturn in China eased after Shanghai relaxed some COVID-19 related restrictions. OPEC has warned that it will be impossible to increase output enough to offset the lost supply from Russia. Brent crude futures went up a $4.58 to $103.06 per barrel, and U.S. West Texas Intermediate contract went up $1.01 to $98.33 per barrel. Let's take a break now. When we come back, we have stories from the African continent to stay with us. This is Business Incorporated on Channels Television. You're welcome back. You're still watching Business Incorporated on Channels Television. Well, in Ghana, the government has restricted the exportation of two commodities, soybean and maize. And this is, according to the Food and Agri Ministry, forms part of measures to ensure food security and increase local poultry and livestock production. Apart from recent data from the Ghana Statistical Services indicating the increased cost of foodstuff, there's been concerns of a possible food shortage in the country, but the Ministry of Food and Agriculture has downplayed these claims. Still talking about commodities now, Russia is the 8th largest producer of sugar in the world. With sugarcane as a major source of sugar, the war in Ukraine has pulled more demand on sugarcane as it's also raw material for ethanol, which is an alternative source of energy. The global price of sugar has increased by 8.1%, so over almost $21 year to date. Well, let's discuss the implication of this with Favor Oguniroye, analyst with Financial Derivatives Company. Hello, Favor. Good afternoon.
Good afternoon. Thank you for having me.
Good to have you. So considering that sugar is raw material for a lot of staple food, not just in Nigeria, all over the world, bread, a lot of cereals, how much of this has impacted the price of commodities and the cost of production in Nigeria and around the world?
Well, one fact that remains is, increased costs in raw materials will lead to increased production costs. So for a commodity like sugar, that means that pastries, beverages, and concessionaires will likely feel the impact of increased prices. But then it could be minimal considering that the percentage change in that sugar price is actually small compared to other agricultural commodities such as wheat and corn, which also form part of input costs for some certain products. But then in the short and long term, we expect that this price and production of of staple foods will be partly dependent on how the global sugar market actually unfolds in 2022, where Brazil sugar mills are now diverting about 60% of sugar cane to ethanol production, like you rightly said. But then it's also still influenced on the movement of crude oil prices as well. Another factor would also be the lingering unfavorable weather conditions coupled with increased fertilizer costs, which is also increasing which is limiting sugarcane planting in Brazil. But at the end of all of this, it's very optimistic for the industry because sugar production in Brazil, in India and Thailand is expected to be strong in 2022. So for manufacturers, that could ease the burden of operational costs to an extent.
Yeah, so talking about Nigeria, our estimated demand for sugar is about 1.7 million metric tons every year. However, 93% of that is imported. However, unlike Nigeria, Gabon has been able to cut sugar imports by almost 50%. What lessons can Nigeria learn from Gabon in this area?
Well, it's no news that Nigeria's agricultural sector is plagued with many challenges, which are also common some of these challenges are common in the sugar industry. I'm talking about financing, insecurity, land disputes, and those are the things that have made Nigeria import dependent on sugar. And recently we've seen a lot of sugar producing companies actually employing backward integration strategies. But something I would like to add to that, if at all it has not been employed, is seeking agriculture experts. So for Gabon, they were able to actually cut down their sugar imports by 50% by boosting local production. So what they did was to actually, allocate about 29,000 hectares of land to agricultural experts. So if such an approach is actually done, that way we are implementing strategies from informed research and expertise. So even though we are getting funds and investments, they are all allocated and deployed in such a way that is efficient and also effective.
And then we see some major sugar players in the industry, manufacturers of sugar in the country. We see increase in their revenue. I mean, with all of this, especially looking at a full year 2021. So on the one hand, it's good news for them. But on the other hand, when you talk to consumers, it's not such a good news. But what's your outlook when you piece all these factors together? What's your outlook for sugar production in the country in the near future?
So, 2022 is actually quite an interesting year. So we see a lot of sugar producing companies and virtually all manufacturers having to do with increased operational costs. One is actually the diesel prices, which has skyrocketed by about 100% in first quarter of 2022. And this is a cost that they have to bear because they need to run their refineries. Another factor is also input costs. So we see that, yes, this sugar producing companies are actually involved in backward integration strategies, but we can't say for sure that is going to totally, replace imported raw sugar. So that way they are still exposed to whatever likely increase in global sugar price that may arise. So what happens is these factors will now influence the company's strategies to either increase domestic sugar prices or increase volume in order to keep profit margins elevated. But then consumers' wallets remain squeezed. So that would be quite a difficult thing to do. But in 2022, all of this will actually, influence investors' decisions as well, because they have to look at the profitability and how all of these factors have played a role.
Obviously, and this will also impact how much the industry can expand and new infrastructure and equipment can also get into that area. Well, thank you so much, Favor, for sharing your thoughts with us this afternoon. Enjoy the rest of your day.
Thank you for having me.
So moving on now, strategies to achieve the global sustainable development goals and support infrastructure and social development for Lagos State and Nigeria as a whole is part of a series of announcements and commitments by the financial sector Deepening Africa. That's a specialist development agency working to strengthen financial markets across sub-Saharan Africa. The announcements were made as part of a 2-week trip led by senior leaders from the UK aid-funded agency in collaboration with partners. And this include Lagos State Government, National Insurance Commission of Nigeria, InfraCredit, FMDQ, and the UN Environment Programme's Principles for Sustainable Insurance Initiative. Moving to Egypt now, following over a month of debates, Egypt's Senate has approved a new government-drafted unified insurance law, which has been described as necessary to cover a host of professions and services recently introduced into the insurance industry. The 217 Article Law, which was approved by the Senate in principle on the 27th of February, will be referred to the House of Representatives to be finally discussed and voted there. Approval indicates that the paid-up capital of an insurance company should be from EGP 150 million to 250 million, and that's in order to be officially licensed. The Senate also approved articles which state that the Financial Regulatory Authority should examine a license request and give a decision on it within a period of 1 month. And if a request should be rejected, it should give an explanation why. Analysts say the past 4 decades have practically shown that the insurance market is in pressing need for new legislative and regulatory rules. That's it for today. Thank you so much for being a part of Business Incorporated. We'll do it again tomorrow. I'm Ini John Mekwa.